you came back from New York in the 56, I think 56. It was, having studied and worked with Ben Graham, what was the dream? What was the ambition?
Well, it was kind of disgustingly low. I didn't know what I was going to do. I had about $150,000 at that time, and I felt, if I earned 10% on that, that'd be $15,000 a year, and I could live big on that at the time. I was interested in reading and taking courses at the university. I took my father-in-law's course in psychology, and I thought I might go to law school. I knew there were a whole bunch of subjects I wanted to read about. And then I sort of stumbled into this partnership a few months later because 7 members of the family said, we want you to handle our investments. And I didn't want to do it one at a time or tell them what I was doing. So I put the 7 together in a partnership that had $105,100 in it. You can guess who the $100 was.
Yes, I know.
and I thought that was it. And a few months later, a fellow named Homer Dodge, who had been a stockholder of Graham Newman, came out, saw me in Omaha, and he said Graham Newman was liquidating, and he said he'd asked Ben where to put his money, and Ben said maybe Warren would be a good choice. So he joined me for, I think, about $100,000 at the time. And then 4 months later, some fellow in Omaha that read the legal notice, actually, a friend of mine called me up and said, what are you doing? And I told him, and he did it. So yeah, I just kind of stumbled along.
You kind of stumble along. Yeah. All of a sudden, you have a partnership,
right,
and you're making money.
And I couldn't sell Keo now, understand? But the partnership did well, and part of the partnership was buying what looked like cheap stocks. Berkshire Hathaway looked like a cheap stock. It was a terrible business. How you might think about investments as opposed to the tendency to focus on what's happening today or even this minute as you go through. And to help me in doing that, I'd like to go back through a little personal history, and we will start. I have here a New York Times of March 12th, 1942. I'm a little behind on my reading. And if you go back to that time, it was just about 3 months since we got involved in a war which we were losing at that point. The newspaper headlines were filled with bad news from the Pacific, and I've taken just a couple of the headlines from the days preceding March 11th, which I'll explain. It's kind of a momentous day for me. And so you can see these headlines. We've got slide 2 up there, I believe. We were in trouble, big trouble, in the Pacific. It was only going to be a couple months later that the Philippines fell, but here we were getting bad news. We might go to slide 3 for March 9th. I hope you can read the headlines anyway. The price of the paper is 3 cents, incidentally. Let's see, we've got March 10th up there, a slide. When I get to this advanced technology of slides, I want to make sure I'm showing you the same thing that I'm seeing in front of me. So anyway, on March 10th, when again, the news was bad. Full clearing path to Australia. And it was like, the stock market had been reflecting this. And I'd been watching a stock called City Service Preferred Stock, which had sold at $84 the previous year. It had sold at $55 the year before, early in January, 2 months earlier. And now it was down to $40 on March 10th. So that night, despite these headlines, I said to my dad, I think I'd like to pull the trigger. and I'd like you to buy me three shares of City Service Preferred the next day. And that was all I had. I mean, that was my capital accumulated over the previous 5 years or thereabouts. And so my dad the next morning bought 3 shares. Well, let's take a look at what happened the next day. Let's go to the next slide, please. And it was not a good day. The stock market, the Dow Jones Industrials broke 100 on the downside. Now they were down 2.28%, as you see, but that was the equivalent of about a 500-point drop now. So I'm in school wondering what is going on, of course. Incidentally, you'll see on the left side of the chart, the New York Times put the Dow Jones Industrial Average below all the averages they calculated. They had their own averages, which have since disappeared, but the Dow Jones has continued. So the next day, we can go to the next slide, and you will see what happened. The stock that was at 39, my dad bought my stock right away in the morning because I'd asked him to, my 3 shares. And so I paid the high for the day. That 38 and a quarter was my tick, which is the high for day. And by the end of the day, it was down to 37, which was really kind of characteristic of my timing in stocks that was going to appear in future years. But it was on what was then called the New York Curb Exchange, then became the American Stock Exchange. But things, even though the war until the Battle of Midway looked very bad, and if you'll turn to the next slide, please, you'll see that the stock did rather well. You can see where I bought it, 38 and a quarter. And then the stock went on actually to eventually be called by the City Service Company for over $200 a share. But this is not a happy story, because if you go to the next page, you will see that well, as they always say, it seemed like a good idea at the time. So I sold. I made $5 on it. It was again typical of behavior. But when you watch it go down to 27, it looked pretty good to get that profit. Well, what's the point of all this? Well, we can leave behind. People can throw Microsoft at me, and you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich, because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't